All right, well, on a night that the Texas Rangers won their first World Series title ever, I've been watching Texas Rangers or listening mostly when I was a kid on the radio, the Texas Rangers baseball games since I was just a kid. And we moved to Dallas when I was in 1980, back to where my dad was from. He's in the Navy, so I was born in the Philippines. We moved back to his hometown, East Dallas. Listening to Rangers games ever since. All the names, I think I tweeted out all the names that I could remember of all my favorite players growing up. Having lived through 2010, 2011, the second World Series, back-to-back World Series, losing both, especially that 2011 series where we were one strike away from winning, only to not catch that fly ball out to right field, and then losing this ultimately that game and then the series in Game 7. So it was a big deal to see my favorite baseball team finally punch through and get it done tonight. So fun night here, and wrapping up the market outlook here after the game. And getting it pushed out here. And we're going to talk about the little winning streak that the market's had to see whether or not it's enough to get us turning back in the right direction post FOMC. So let's go ahead and get started. Today is Wednesday, November the 1st, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. Hit that like button. Again, that helps us get our content out on those platforms. That's why we always ask for it every day. Thank you to those who do that day in and day out. Those who don't, you can do right now while we're watching with one or two really easy clicks to see if we can't get to 100. That's our goal every day. So you can do that, again, like I said, right now while you're watching. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So we did rally again, 3 days in a row now to the upside. Still still no bear tag even. So we're still about 1% below the moving average. But it's a good little rally. It's the biggest day. You can see the range yesterday was 42 points. The range before that was 44. Today is 47, almost 48 points. So still all below average. Still not the kind of rallies you like to see. You like to see these kind of rallies, like a big move here. Like the range there was 96 points. The range here was 100 points. And the ATR probably wasn't as high as then as it is now. But regardless, like these are small. I mean, the ATR is 55 points, and we can't get a 55-point day. So it kind of goes to show, again, I mean, the near-term line rallied. It rallied up here into it. Now, it did get above 90th percentile over here as well, and it failed, right? It got up to the 90th percentile, right to it there with the momentum line this time, and failed. The momentum line is actually the lowest of the three, which, again, suggests the likelihood that it will fail too, and that will most likely come down. Remember, we had a 4-day streak here, and here we actually did have a 104-point day. I mean, that's the kind of day we like to see right now to really get us going. That started a 4-day streak, and it failed. So we're really kind of struggling here. We're not getting the kind of rally we'd like to see. The weekly chart here on the market forecast, again, like we said last week, right? If you go back to Fridays, we said it's probably going to get a bullish week this week, and probably next week we're going to fill in this gap back up to the moving average, because that's what we do when you get these bull tags, right? You fill in the gap typically back to the moving average. We did it there. We did it on some of the others as well. We had a 1 week there where we traded back up to the gap. That's just what happens. So that didn't stop us from getting the rally here, didn't stop the intermediate line from falling below 50. So that's why we have the dark pink shading. Obviously still below market sentiment, which is at 60 and still rising. But as you can see, it's not rising very fast anymore. So it's unlikely to get too far above 60 if that intermediate line stays below market sentiment for a long time. And the near-term line's been below the intermediate line since the intermediate line crossed below 80. The near-term line's been below it this whole time. So this week even, we haven't got the crossover yet. We'll see if that ends up happening. Obviously, still 2% below the 30-week moving average. And of course, as was mentioned on Monday, yesterday we did finish, but we did not get the red line. We did get a bull tag, and I tweeted this out here. I tweeted this out. This is the lowest the intermediate line is since 2008. So to kind of give you an idea, all these other bull tags, and I'm only counting this first one here, right? Because the others are kind of like, it's a cluster of bull tags. You only count that first one. So if you were to go back all the way out to like, let's just go all the way back out to since we became a 500 stock index on a monthly chart. Here, let me put the monthly chart here. So the intermediate line over here on this bull tag, you can see, was at 67.3. Remember, we are at 65 right now, or it was at 68 last month, 68.8. So pretty much 69. Over here on 2000, we got the bull tag, we were at 65. All these other bull tags where we bounced up, the intermediate line was in the reversal zone or just barely below it, right? Just barely below the green line down here, either in the reversal zone or just barely below it. This one, like the other two that ultimately led the bear markets, was higher, right? Look at these two bull tags that bounced up just below the 70th percentile, just below the 70th or the 80th percentile. Neither one of these are in the 60s like the bear markets were. Coming back out to like the 70s, when you got this bull tag right here, the intermediate line was in the 65th percentile. So here we are. You know, again, we've had 3 bear markets, 4 if you count the 1981, 82 bear market over here, which really wasn't very much of one, but you could count this one as 4, and that was the 68th percentile there. All 4 of the bear markets that we've had since 1973, all 4 of the bear markets started with a bull tag where the intermediate line was below the 70th percentile. All the other bull tags that bounced had intermediate lines that were above the 70th and barely below the 80th percentile. So again, it kind of goes to show, and we've had a rally here, so it's not this, you wouldn't count this as one of these 4. This is its own bull tag now because we rallied back up to dark green shading and a green line. So it's its own bull tag, and like I said, the intermediate line failed to get above market sentiment. It's already rolling back down, and we already have a bull tag with, you know, what you would expect would ultimately lead us, as it did on all the prior instances, to a bull bear market. If we take a look, you know, that was just the S&P. Let's look at the Russell, which has been on the weak end of things, and still, look at that 3-day streak. I mean, we're still over 3% below. And the near-term line rocketed up to the 98th percentile practically, but not the momentum line. And it's already falling. And again, the market sentiment's already in the lower reversal zone. Not the kind of move you'd like to see. You'd like to see that momentum line get up there to really solidify. You'd like to see a bigger move than the ATR, and we're just not getting that. The NASDAQ, of course, has been the big gainer today, almost up 2%, 1.77. Again, its momentum line is actually still rising. We'll see if it ultimately gets there. It did have almost an average day today, so that kind of goes to show just how small these days have been. That, you know, that looks like it's a good day, and it was like barely below average. And it's still a 0.5%, and we still don't have, like, the intermediate line's above 20. It's not above its market sentiment yet, and it's still below the moving average. So again, not trend changing yet from a market forecast standpoint. Let's take a look at the other weekly chart here, and you can see we are getting a higher close as of right now. We got 2 more days left, but as of right now, we're getting a higher close on the Hakinyasha candle. So that's a good sign. A higher low and a higher close. We'll see if that ends up turning into something. I don't think it will, but if it does, that's the first sign, right? Getting a higher close is a very good positive development that ultimately would lead to a transition candle, most likely, if not to a good bullish candle next week. So that's kind of the expectation there. We'll see what ends up happening. We're still below the 200-week, 40-week exponential moving average. We need to get back above that 40 and 10 for that matter if we're going to really turn it around. to the upside. Looking at the 3 green arrow charts, we got a green arrow on the S&P. So we got a green arrow on the MACD. We got 2 green arrows on the Dow, the stochastics as well. We got a green arrow on the Russell. So the NASDAQ, which is that close, 0.1177 away from a red arrow there, is the only one. But pretty much everything is in convergence mode, right? Not one of them yet has gotten 3 greens. And that's kind of what you need to see is a 3 green and then a follow through of those 3 greens in order to maintain the bullishness, because you can turn right back down pretty quickly, especially when the MACD is where it's at. If you look at the MACD itself, it's still negative. It's below its moving average, but it's still negative. Last time it got up to 0, it barely got above it and turned lower. And we'll see, we're at the 17-day. We haven't even gotten this 3-day rally didn't even get you above the 17-day, much less the 200-day, which is a really important level. It did get you above some important Fibonacci levels here, the 23% retracement of the post-COVID rally, the 50% retracement of this intermediate rally we've been retracing, as well as, again, holding the 50% retracement of the correction rally from 2022, correction decline, as well as the point of control as of right now. Again, looking at IWM, it's a much different story and nowhere near the 17-day. So keep that in mind. The Qs, which are more bullish, are barely above. And look at all that volume that's above it. So again, very hard to be super bullish right now when you've got a tremendous amount of resistance above, not including the moving averages, right? And these Fibonacci levels. But you got the 23% retracement of this intermediate rally. You've got significant resistance keeping you below that, which, remember, you start the retracement when you get below it, you end it when you get back above it. And it's going to be hard sledding to get back above it and be able to stay there. If you take a look at some of these other oscillators, if you look at the DMI, you see that we are improving. Like, we're not nearly as negative, and we expected that we would improve. But again, we're not below 25 on the negative. We're barely below 30. We are below the ADX. That's a positive sign. And we're not above 20 on the positive either. Last time we got above 20, we didn't get above 25. So, this is even worse. So, we can't really necessarily say, hey, this is looking great, right? The RSI is above 40, so it's not bearish, but it's not above 50, much less above 60, which is what it needs to be able to end this move that we have going on right now, this bearish run, right? You got to get not just above 50, but you got to get above 60 to turn bullish, and so we're not there yet. And then, of course, the weekly CCI needs to get above 100 to turn it bullish, at least above 0 to stop being so bearish. But it's got to get above 100 to start a new green box, as you can see here, and we're nowhere near that, right? Nowhere near that being the case. And even that was short-lived back in August when the Fed Chair Powell came out and said, we shouldn't be this bullish. All right, looking at the the Ichimoku cloud, you can see we're still below the blue line. We're above the green, we got above the green today. The rate of change is still negative, which means, again, we've been, we're lower now than we were 26 days ago. We're still below the blue line. We still have roughly an intermediate trend strength. We're still above 65. We're not quite below -2 anymore. That's intermediate trend strength level. So we're not quite there yet. But we haven't lost the trend, and of course on IWM we haven't lost the trend either. It's a very mature trend. We haven't even got above the green line on that. The rate of change is hugely negative. Looking at the Qs, the rate of change is actually positive. We're actually slightly higher than we were 26 days ago. We're still below the blue line and the cloud. The cloud's still pink. We haven't crossed, and we still are close to an intermediate trend strength level there as well. Looking at the Bollinger Bands and the Keltner channels, we are up to the midpoint of the bandwidth, but we're not through it, right? So that needs to change if we're going to be bullish. You can see the bearish momentum we have is already turned yellow. Obviously needs more than just one day of that, but at least, the bands themselves, the band width appears to be peaking. We might be kind of reducing the momentum here. You can see that's about the time that when the momentum shifts is about the time that the Bollinger Bands band width peaks, and we start coming back towards the Keltner channels. So it's been a nice little rally to get from below the Keltner channel to the midpoint of the range. we'll see if there's anything more to it than that coming up the rest of this week. Obviously, we had a higher high today, a higher low. We close at the high of the day. We close at the point of control. We close at the 4-week range. In fact, when you look at it from this perspective, we're right there at the midpoint practically. Last time we did get slightly above 60, but we failed to get really bullish. So we need to do more than this, right? We need to get above 60. We need to get really above 80. And even that's not a guarantee, but we need to get above 80 really if we're going to turn bullish and stay bullish. Get above 80 and stay up there. So what you can see, we're not there and we're not close yet. And I would expect this resistance most likely to hold. I think we've probably rallied a little too much in 3 days. Even though, again, none of these days were above average. Put together, probably a little too much. In fact, if you look at the rate of change over the past 3 days to see just how bullish this little rally has been, cumulative, it's about 3%. So it's a pretty strong rally relative to what we've seen over the past year. There's been a few others that have been stronger in March, and that kind of started a move higher. And then again here in February on the earnings, the tech mega cap earnings, and of course over here in November coming off those lows. But it's a pretty decent rally. Last time we were up close to 3% in 3 days. We stayed up for a few more days, but that essentially was the peak. We kind of stayed right around there till expiration, and then we fell pretty hard. So, again, like I said, probably a little too much of a rally, even though, like I said, neither one of these days was that bullish. Some of these moves started with a really big range there and a really big range here. These moves included these big moves. This one hasn't. So again, I think it's likely that we don't hold up. If you look at the ATR, it's falling. That's not really what you want to see yet, right? Not until we've actually kind of changed the trend, because you want big moves down here. I told my class today, if you look at we crossed below the 50-day moving average over here on August 15th. We crossed below the 200-day moving average on October 20th. So if you look at like this chart and you look at August 15th, so right here, if you look up here at the top, to the right, left of my cursor, starting with this green bar, to the left of my cursor, those are all the returns above the 50-day moving average, and starting with this red bar, if you look to the right of my cursor, those are all the returns below the 50. You notice not only did we get more and bigger down days, but we also had some pretty big up days too, relative to above the 50-day. Well, 1020 is when we close, so right here, this day, so starting with this third red bar, that's 1020. That's the day we crossed below the 200-day moving average. So everything to the left of my cursor is above the 200-day moving average. Everything to the right of my cursor is below it. You notice there's not much difference there, and that's not normal. So again, we really haven't had the move yet, the washout move, where volatility rises. I mean, look how low volatility is. The VIX fell below 17 today. We're in correction mode, and the VIX is at 17. We're in correction mode, and the VIX is almost at 90% again. I mean, over here, we were not in correction mode yet. We're in correction mode now. We're in full-on correction mode. A lot of indicators, like I've been telling you for the last so many weeks, we are full-on correction mode. The VVIX is at 85. The VVIX is at 85. These are extremely low levels for volatility, considering the kind of market we're in. Again, I think we rallied too much, even with not even that big of a day, but cumulative, we've rallied too much in 3 days, and the VIX has dropped way too much for us to be able to really maintain bullish momentum going forward. We're so extreme to the downside. I mean, we're already sitting on the 50-day. I think more than likely we're going to get a bounce back up here in volatility and sustain some more weakness going into the end of the week and into next week. I thought this week would be a bullish week, and so far it has. And we probably still will finish with a gain. Probably won't be as big of a gain as we have right now. I think there'll be some weakness, but probably not going to be a good week next week. It's probably not. I thought we'd have 2 good weeks here, small, with some volatility, but ultimately 2 good weeks to get back up to that 30-week moving average. probably not going to be the case. We probably pulled it all forward into the past 3 days, and now more than likely we'll probably end up with a down week and increased volatility because of how extreme the decline has been. Trying to front run the Fed and then coming out of the FOMC meeting. All right, now let's talk about what's driving this price action here today. Let's take a look at just today alone and how things moved here. And then we'll look back it out to the past 3 days total. You can see the bond rally. Again, bonds put a lot of pressure on IWM more so than anything during this decline, but not today. Like bonds really rallied today, and so did the Qs. Very strong move higher. IWM was actually down until the Fed announcement, really until the press conference. Then IWM really rallied and picked it up after that, but still really underperformed everything else. The dollar was up most of the day, finished the day relatively stronger. Gold down, not surprising. Let's back this out now to this 3-day win streak that we've had for the S&P 500. And you can see, again, it's pretty much all the Qs, right? There's the Qs, there's real estate, developed markets, IWM doing okay, 2% gains. But again, some of it's due to bonds rallying, but that's not really that big of a move. Gold is down, commodities are down. That's probably one of your bigger drivers. But it's just basically an oversold bounce of what we've had, especially in small caps, but lately and over the last couple of weeks in these large cap names. In fact, if I were to back this out to the 2 weeks prior, then you can see those were the two biggest loser. IQs were one of the biggest losers here, and they've rallied, but you can see they're still down. They haven't rebounded as much. If I were to back this all the way out to when this whole thing started, back on August the 1st was the first down day, then you can see, again, IWM has been the biggest loser, but it's been the Qs here lately. That's why we're getting the bounce up that we did. Bonds are still such a big loser here during the entirety of this correction that we've been in. And of course, the dollar strength has been one of the biggest reasons why. And you can see that, again, when you look at some of the charts here, looking at the dollar for an example, just kind of going flat here lately as we're in this convergence mode. TLT rebounding, but still not breaking that 17-day moving average yet. Of course, crude oil has been declining, rallying for most of the initial phase of this correction, and then pulling back down towards its support level. Of course, that's what caused a lot of the angst from inflation expectations rising. You can see the 10-year yield rose initially, but then it's just kept going up. It's down today below the 17-day. So we'll see if a continuation of this move helps push equities higher. Taking a look at the sector rotation, again, we'll take a look at just today alone first. It's not going to be surprising. You could probably guess which sectors, what's going on here? Which sectors did the best here today. So let's come out here to November and just look at today first. We'll come out to like 5 minutes. And technology, communication services, and discretionary. Interesting to see utilities up here. Again, really benefiting from the drop in yields. Utilities continue to be strong. If I were to, again, to zoom out to the last 3 days, so this big win streak that we've had, communication services and technology have been your big winners. Financials also rallying. Utilities up there too, along with real estate, so interest rate sensitive areas. Energy lagging behind. That's been a beneficiary of the weakness. In fact, if I were to go back out again all the way, let's go back out to the 2 weeks, like we saw here on the asset class. There's your strength in utilities and staples, whereas technology, communication services, discretionary and real estate have all been relatively weak. They're rebounding here, not quite back up to break-even levels. And of course, if I were to go all the way back out to August the 1st, when this whole correction started, again, energy had been a big winner. It's been declining. Communication services, technology up there, holding up better. Utilities was such a big loser it's rebounding along with staples and real estate rebounding a little bit too. So you can see, kind of the bounce up that we've been getting over the past 3 days is simply just a rebound from areas that have been down the most over the course of this correction. But as we mentioned, it's not, obviously we're not breaking back above zero on any of these sectors here, nor are we showing any signs of a new trend developing on any of the indicators that we've been watching either. All right, let's take a look at our trade idea of the day. Let's take a look at Palo Alto Networks, PAN-W. You can see, it's interesting to see how, of course, we've gone from dark green shading, light pink, dark pink, back to light green shading. It's the intermediate line. Had dropped out of the reversal zone, out of bullish territory, below its market sentiment line. But it looks like it's kind of stopping here as the near-term line has crossed through the intermediate line much more than it did last time. And is making its way up flat. Again, we've had the moving average here. We've been right around it. We've had a red line, yellow, green, yellow, red, yellow, green. So it's a pretty sideways action. You can see the weekly candles that we're getting on Palo Alto Networks are all sideways, kind of neutral candles, red, green arrows back and forth. The 3 green arrow chart, when you look at it here, sitting right on the point of control, there's a pretty decent gap in volume down below to below the 200-day moving average if it does make its way down there. As of right now, it doesn't look like it's got the potential for doing that, as it's actually on the other, more likely turning slightly higher instead. We've had a bullish move, bearish, bullish, bearish, just kind of fluctuating up and down. Of course, that would suggest that the next move is to the upside. Looking at its RSI and CCI, you can see they're both right in the middle of their charts. A very neutral standpoint there of looking at the Ichimoku cloud. We're actually above the Ichimoku cloud. Rate of change is positive, starting to get a very weak, that is right there, right at 1, right at 50. Right at those numbers, that is a weak bullish trend that we have going on there right now. So, and then finally looking at the Bollinger Bands, the volatility that we've had is starting to come down as we center ourselves right on the point of control, and as the bands themselves move back inside the Keltner channels. All this, we've had green dots for quite a bit of time. Only one day did we have red dots. So you would expect that we'll probably get an extended period of red dots now, which means that we just kind of go sideways here for a while. So what I did with that is I decided to come out to the December expiration, sell those low 20 deltas on one side, 20 delta over here on the other, and then buy one strike away for protection. That sets us up right here for this iron condor spread. And you can see where we put our break evens at when you look at the 2 green arrows, 3 green arrow chart again. Those break evens right there. So I have room to the upside. So you can see room to the upside through December for this to move. And if it breaks through any earlier, we'd just close out this trade and look for a more directional trade. On the downside, you can see I've got a little bit of support from some old touches over here and a little volume node. The 200-day moving average, of course, would be right around that area. Breaking through there, we'd be looking at more of a bearish trade. So I like the neutral setup here. So we did it's a $10 wide spread. So we only did one contract. 2/3 of what a normal risk is for a pretty decent reward for a normal risk. So we're going to put that trade through for today's trade idea. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.